Hi guys, welcome back. We'll continue our tutorial and we'll look at time frames. Now, the more data that goes into each candle, the more reliable will be the feedback from the chart. So, in a sense, the daily chart will be more reliable than a 4-hour chart, and the 4-hour chart will be more reliable than a 1-hour chart, and so on and so forth. So the more data that goes into each candle, the more reliable the feedback from the chart will be. And that daily chart will be more reliable than a 4-hour will be, and a 4-hour will be more reliable than a 1-hour will be, and so forth and so forth. So you'll find that the feedback from the chart will always be more reliable with the longer time frames. If you probably look at it from a human analogy point of view, say for instance, I suppose it's like everything in life. You just find that the more the data, the more reliable it will be. Say for instance, say you have a major decision to make, say in your life, who would you look to get more reliable information from? Say you had 3 people to get information from. Who would you look to get better information? Not that getting information from anybody is it's not will be unreliable, but it's just that depending on people on who you ask for advice, the experience, you will get a feedback that is as reliable as the experience that they've had. What do I mean by that? Say for instance, say you ask for a major advice, say from a young fella. He's only got maybe about 10 years worth of data, so he will have a good opinion, but compare that with say somebody else who's say much older, say in their 20s or even 30s. They're probably working from a higher number or a much more bigger database of experience and could advise them perhaps better. Or if you move on and say and ask for even somebody who is far older, has gone through quite a lot of the life's experience and ups and downs, and obviously can offer even far more in terms of the vastness or can tap more from that vastness of experience of learned over a longer time, which really in some ways equates to this analogy equates to the time frames. I mean, say the asking for this elderly gentleman could be almost like looking at say a 1-hour chart, and then asking the young lady could be equivalent to looking at say a 4-hour chart, and then asking the young 12-year-old maybe equivalent to looking at an hour chart, and so on and so forth, and so on and so forth. It could be and that goes down as well as you go to these even smaller time frames like 30 minutes, 15 minutes, 5 minutes. The more you go down to those levels, the less reliable the information that you'll be getting, or the feedback from the charts you're going to be getting. I personally look at the longer time frames, not the short time frames. It gives you time to look at the market. The signals are very clear, and then you can trade in knowing that you've got a long data base that you've analyzed, on which you have made your decision to enter into the market. So let us summarize this the charts. I'll look at the charts overall. We said don't predict, react. There's no crystal ball. Don't try to predict the future. Nobody can. You can't predict what is going to happen tomorrow, next week, next year, or even in 10 years. Don't even try. What you do is you look at the market and you react to what is happening in front of you. So what are we looking at? Only buy in an uptrend and only sell in a downtrend. So in an uptrend situation, you're buying. When things are bullish, you're buying, and then in a downtrend situation, when things are bearish, you're selling. So you're selling short. Use daily charts with 1 year's worth of data, or whatever it's provided using the platform. So in a sense, use a daily chart because it does give you a longer data in which to sort of look or form your chart and obviously see the trend in the market. Then add a 200 period simple moving average to your chart. Use an indicator of your choice. There are many types of indicators. We looked at the slow stochastics. There are other ones like the CCI. You got the MACD. You can investigate all of these different indicators and see which one works best for you. They all do virtually the same thing. Then look at the uptrend. The price action is making higher and higher lows. In the downtrend, the price action is making lower and lower lows. Those are the things that you'll be looking at, or the characteristics of the charts that you'll be looking at to decide which way the chart is going, uptrend, downtrend. And if it's an uptrend, obviously you're looking to buy. If it's a downtrend, you're looking to sell. And the 200 as a simple average will help you to decide it's an uptrend or a downtrend as well. And then use longer time frames. Again, don't predict, react. Price action below the 200 simple moving average is an uptrend. Price action below the 200 above, is an uptrend. The price action below the 200 simple moving average is a downtrend. Pick the pair to trade with the longest and smoothest trading cycle. Enter the trade after a pullback when the price moves back to the direction of the trend, or enter the trade after the price breaks through the previous support in a downtrend or a previous resistance in an uptrend. That is how you can enter the market. Those are the two methods of going into the market. We've discussed this in previous tutorials. You can go back and review those tutorials again. That will bring us to the end of this guide to the simple guide to the charts. We've been looking at the trends and how to follow the trends. You can it gives you very clear direction in terms of how you can look at the charts. I always say keep it simple. The simpler the better. Less is more. Don't clutter your charts. Just look for simple signals. You can trade, investigate, try as many look. Just when you go into your practice platform, try, experiment. It's a good platform to experiment. Look for clear indications, clear signals, and obviously trade, but form a discipline in knowing exactly what you're doing and why you're entering a trade and coming out of a trade. And with that, we'll come to the end of this tutorial.